Now, successful economic growth in economies is dependent upon a high degree of monetary and fiscal policy coordination between central banks and government. One of the roles of the Central Bank of Nigeria is the regulation of stock of money. The role depends on the use of monetary policy, which is targeted towards the achievement of economic variables such as rapid economic growth, price stability, equilibrium, full employment, and external balances. Well, let's get talking. And from our Abuja studios, I'm being joined by Professor of Finance and Capital Market at the Nasarawa State University, Professor Uche Uwaleke. Professor Uwaleke, thank you so much for being on the program. It's good to see you.
Yeah, thank you, Tolu. Good to see you too. And by the way, congratulations to you. Congratulations to TVC. I'm talking from your beautiful Abuja studio, brand new studio in Abuja.
Thank you so much, Prof. We appreciate that. Prof, the president is talking about reviewing some moves by the monetary policy authorities. But first, I'd like us to do a rejig or an overview of some of those orthodox or those policies of the central bank that were away from the regular, that you think that might have impacted positively or negatively in your view.
Well, to start with, when you talk about monetary policy, it's an economic policy that central banks, the world over, used to manage the size and the growth rate of, money in an economy. It can also be used to manage or control the direction of credit. Central banks you find them either applying what is known as contractionary monetary policy or tightening monetary policy. In other words, trying to reduce the money supply, or expansionary monetary policy, or loose monetary policy, in which case the attempt is to increase money supply. And of course, in doing that, the central banks have at their disposal certain tools. The traditional ones include the open market operations, where securities are either bought or sold depending on the intention, whether it is monetary policy tightening or the loose one that I mentioned earlier. Of course, you also have the main tool, which the CBN has been using, the monetary policy rate, which represents the anchor for interest rates in the economy. Central bank uses the MPR to target short-term interest rates. That's the rate at which the central bank lends to the deposit money banks. And today it's 18.5%. And if you add the corridor, usually set within a corridor, asymmetric corridor, in our own case, +1 minus 7. So when you add +1, which is the standing lending bound, plus 18.5, you have 19.5. So central bank effectively lends to banks at 19.5. Of course, the higher the monetary policy rates, we should also expect that under the interest rate channel, the interest rates in the economy will be high. Then you also have liquidity ratio, which is the proportion of deposit liabilities that must be kept in liquid form, cash and near cash items, and the rate currently is 30% in Nigeria. There is also the cash reserve requirement that is around 32, that is 32.5%, and of course you also have the United.
Thank you for staying tuned. I still have Professor Uche Uwaleke there speaking. Prof, now I'll follow up with asking that you were making a point. I'll allow you complete that. But it seems like all of the efforts of the Apex Bank in recent times to rein in inflation seems not to be working. You alluded to the fact that NPR is now at 18.5%, chasing inflation at 22% or above. What is your reaction to this?
Yeah, I was providing a background, and I was telling you that the central bank has at its disposal some traditional, tools of tackling inflation, and that the whole idea is to reduce the money in circulation, to reduce money supply, and that money supply, by central bank definition, if you take the broad money supply, that's talking about the currency in circulation plus savings deposit plus the time deposit. So if the cost of inflation is as a result of too much money out there, then the traditional tools, will work. But if the cost of inflation is more as a result of some other factors, possibly outside the control of the central bank, then the traditional tools, become weak. They become ineffective. So the traditional tools only work where inflation is demand-side driven, where, if you like, we say it's as a result of demand pull inflation. But if it is a cost push type, then the traditional tools, will fail to curb inflation. What has happened since May last year, when the central bank, changed gear from a supposedly accommodative policy stance to, a tightening stance, has to do with the fact that the pressure on inflation, has come more from the supply side. Okay, what are these supply side factors? We are talking about, issues to do with inadequate food output. Okay, if you look at even the GDP numbers, confirm that the agri sector has, even though still in the positive territory, but the growth rate in the agri sector has been very weak, at below 3%. So food output has been seriously affected, majorly on account of insecurity. So it is not the central bank's duty to tackle insecurity. If insecurity is stopping people from going to farms, farmers, herders, clashes, kidnapping, and so on, that is not the job of the central bank. So that alone is why you have the pressure, inflation pressure, coming more from the food side. Today, the food inflation is over 24%. The overall inflation, average inflation rate is 22.22, but food inflation is over 24%. And in some states, if you disaggregate the food inflation figure, in places like Kogi, for example, the food inflation is over 27%, according to the National Bureau of Statistics. So you also have the issue of high cost of electricity. Okay, that's now speaking to structural legacy factors, structural factors. High cost of electricity is also contributing. Fuel issue, energy issues also contributing, fuel scarcity. So the fact that we have had these challenges, as I said earlier on, are also, rubbing off negatively on, the general price level. And there is also climate change. In recent times, we've seen flooding, again affecting, food output. So when you aggregate these factors, you realize that there are also factors that are exogenous to the central bank. Central bank, has little or no control over them. Yes, I agree to the extent that over time, ways and means have also contributed to fueling inflation. We also have, the fiscal surprises. By that I mean the fact that the government, particularly on the federal side, has also been, running expansionary a budget that is more on recurrent side. So increased government borrowing also fuels inflation, particularly when you borrow and the borrowing is not plowed to productive sectors. So these are some of the factors that are fueling inflationary pressure in Nigeria. And there is also don't forget too, the issue of exchange rate. The high exchange rate is also contributing to inflation. And with respect to high exchange rate, do we blame the central bank? Again, it also boils down to, demand and supply factors. If the demand for forex, for example, is very high on the part of Nigerians, on the part of our, something in part to do with our penchant for foreign goods, again, that is not what it's not. You wouldn't blame the central bank for that. So I am saying that the primary responsibility to tackle inflation is on the doorsteps of the central bank. The CBN Act is very clear that is the mandate of the central bank. Okay, and that's why within that mandate you have the Monetary Policy Committee responsible for monetary policy, specifically. But I'm saying that there is a limit to what the central bank can do with respect to inflation in Nigeria today because of the many factors that are driving inflation. And that is why I think to drive down inflation rate in Nigeria, realistically, the fiscal authorities and the monetary authorities must actually have a handshake. You notice that since May, Central Bank Monetary Policy Committee has been hawkish. Let me use that word. Driving up MPR, and inflation rate hasn't really significantly come down. On the other hand, it has been rising. Although some might argue that without the tightening stance, that maybe would have been having galloping inflation, by now. So why the central bank is unable to rein in inflation effectively using the traditional tools, I repeat, has to do with the fact that there are a lot of extraneous factors outside the control of the bank.
Interesting. Prof, let me ask you this directly, because when we say we want that handshake, one of what I think would make that handshake and that synergy work properly would be the issue of cutting costs, which takes me to subsidy removal. And I'm sure you have your reaction to this, particularly as government has taken that step and Labour has also suspended their intended strike. What is your reaction to this, and where directly do you think some of these monies that will be saved from subsidy, where do you think it should be channeled to?
Well, let me say upfront that I'm in support of the fuel subsidy removal for obvious reasons. We can't. It's really unsustainable. The fiscal pressure on the economy is, becoming unbearable. Budget deficits are widening, and even the debt burden that we are currently carrying, doesn't support further borrowing to, put on subsidy. The opportunity cost is also very high. If you take into cognizance the fact that we are spending trillions of naira on this subsidy in between January and June alone, 2023, in the budget, we have 3.36 trillion provided for subsidy. So if subsidy doesn't go, it means by December we'll be looking at 7 trillion naira, something in that region. And you can imagine what 7 trillion naira can do in education, in health, in some other critical sectors. So when you talk about opportunity cost, that's what it means. The cost of the benefits forgone. So the opportunity cost is really high. Where subsidy is crowding out development funds. And of course, it's also fueling, smuggling. Smuggling is also incentivizing smuggling. Now, having said that, it's also important to recognize that this is a problem we have had over the years, and I'm happy that this government is, brazen up, is ready to deal with it. But in dealing with it, again, we have to be a lot careful because it's something that has been on over the years, and I don't think it's something that we can solve in one fell swoop. By that I mean we'll jack off the subsidy in one fell swoop. The impact will be, quite distortionary. The distortion in the economy will be much. You expect to see very rising rate of inflation as a result. Inflation rate is going to rise. And this is also going to come at the same time we are talking about unifying exchange rates. When you unify exchange rates, yes, if you unify exchange rates and you also remove subsidy 100% at the same time, the negative impact on the economy is going to be well, particularly on the masses, on the poor Nigerians, will be much. So I am recommending, a phased approach. I'm also suggesting that the first thing first, and that first thing is which, from what I've read today, I think the government has started doing. That the government is already trying to even audit what has been going on. We need to audit the system to get evidence, upon which we will now act. Whatever action we are taking should be evidence-based. So let's even have the statistics. When we talk about subsidy, how much actually is this subsidy? How much do we consume in this country? What quantity do we consume in this country? In terms of fuel consumption, nobody can tell you today that this is the real figure. Some will bandy a number, a lot of numbers, 70 trillion, million liters, 60-something million liters. Nobody's sure. So we need to do an audit to understand what the problem is. I'm happy I read again that the president has ordered the NNPC to terminate the direct sale, direct purchase arrangement. So I think these are good moves. And as I said earlier on, part of what the Labour, should be discussing with the government is also how to see that this thing is faced, and more importantly, to compensation measures. Compensation measures that should be in place, to cushion the impact. But let me also say this. While I'm not against increase in wages, minimum wage, of course I support it, it's overdue if you look at inflation rates over time. But we should not be increasing minimum wage just because we want to respond to the removal of first subsidy. And that's because, remember, we are talking about 200 million Nigerians. Minimum wage is only something that affects, the civil servants, basically civil servants. All right? And how many are there? If you take the federal, those that work at the federal level, civil servants, they are not more than 2 million. Even if you take both those of the states, even when, as we speak, to the best of my knowledge, not all the 36 states have implemented even the 30,000 naira minimum wage. So let us even assume that they will all implement, all the state governors will implement, and we are talking about, again, a number that is fewer than 10 million, and you have 200 million Nigerians. What about the rest of us that are not working, that will not enjoy the minimum wage? And even in the private sector, it's only the organized private sector, some of them that may even comply, because a lot more people are outside the formal sector. And even with the 30,000 minimum wage, you see a lot of people today in Nigeria still earning 20,000, 25,000 below the minimum wage. So it's not, for me, it's not about raising minimum wage, because that also has its inflation, implications. It is ensuring that out-of-pocket expenses are minimized. In the health sector, for example, is a good one. They are talking about you expand the national health insurance scheme so that the majority of Nigerians can be part of it.
Now, we have to let go.
So we should focus on compensation measures. Otherwise, this idea of removing
the program would have you to speak around this some other time. Thank you so much, Professor Uche Uwaleke, there from our Abuja studio.